The Federal Reserve just made what they're calling a close call, a quarter-point rate cut that came with 3 dissenting votes, the most divided than it has been in years. But here's what nobody seems to be talking about. The real market mover wasn't the cut itself, it was what the Fed didn't say, what they refused to promise. The silence that echoed louder than any policy statement. And that's the thing about central banks in December 2025. They've discovered something remarkable. They can move trillions of dollars in global capital without actually doing anything at all. Just by standing still, just by keeping quiet, just by letting markets fill in the blanks themselves. This is the story of how inaction became the most powerful tool in monetary policy, and why it's working exactly as mainstream economics says it shouldn't. Let's start with what just happened. Wednesday, December 10th. The Fed cuts rates to a range of 3.5 to 3.75%. Third cut in a row. Markets had priced it in. An 80% probability going into the announcement. Nothing surprising there. But then came the dot plot, the infamous chart showing where each Fed official thinks rates should be. One more cut in 2026. Just one. Down from the market's expectation of 2 or 3. And suddenly, Treasury yields are climbing. The dollar is strengthening. Equity markets are stumbling before Powell even opens his mouth at the press conference. All because of a bunch of dots on a chart. Dots that represent nothing more than current opinions, not commitments, not promises, not binding policy, just forecasts that will change the moment the data changes. But markets treated those dots like gospel, like monetary scripture. Because in the absence of clear forward guidance, in the absence of explicit commitments about what comes next, markets will latch onto anything. They'll trade on shadows, they'll price in silence. And the Fed knows this. They've known it for years now. Look at what Powell said during the press conference.
We're well positioned to wait to see how the economy evolves.
We're well positioned to wait and see how the economy evolves. We haven't made any decision about January. We'll carefully evaluate incoming data. Translation? We're not telling you what we're going to do. We're not even hinting. You're on your own. This is the new playbook. Data dependent. Meeting by meeting. No forward guidance beyond vague platitudes about dual mandates and balance risks. It's the anti-2013. Remember back then? When the Fed would tell markets exactly what economic conditions needed to be met before they'd taper asset purchases. When they'd provide calendar guidance about how long rates would stay low. Those days are gone. And they're never coming back. Because central banks figured out something crucial. Forward guidance constrains them. It boxes them in. The European Central Bank learned this the hard way. They spent years promising to keep rates low for long, tying their hands with explicit commitments about inflation forecasts and economic thresholds. And then inflation spiked, supply chains collapsed, energy prices exploded, and the ECB found itself trapped by its own promises. They couldn't hike fast enough because they'd conditioned markets to expect patience. They'd trained investors to believe in gradualism. And when they finally had to break those promises, when they had to move faster than they'd signalled, credibility took the hit. Trust eroded. The very thing forward guidance was supposed to protect. So now, the ECB has joined the Fed in strategic ambiguity. Their December meeting, they held rates steady at 2%, third pause in a row. And Christine Lagarde gave the press conference performance of the year. Lots of words, very little substance. The economy is growing despite challenges. Inflation remains close to target. The outlook is broadly unchanged. We're determined to ensure price stability. We'll follow a data-dependent approach. Notice what's missing? Any hint about what happens next? Any suggestion about whether December brings another pause or a surprise move? Markets are split. Some think the cutting cycle is over. Others see potential for more easing if growth weakens. And the ECB is perfectly happy to let that uncertainty persist. Because uncertainty does their job for them. Here's the mechanism. When central banks refuse to provide clear guidance, when they deliberately cultivate ambiguity about future policy, market participants have to do the work themselves. They have to build in risk premiums, they have to price multiple scenarios, they have to hedge against outcomes they can't predict. And all of that shows up as tighter financial conditions without the central bank actually tightening policy. It's brilliant. Restrictive monetary policy without restrictive interest rates. Markets tighten themselves. Bond yields rise, not because the central bank hiked, but because investors demand compensation for policy uncertainty. Credit spreads widen, not because of higher benchmark rates, but because lenders can't confidently price risk when they don't know where policy is headed. The Bank of Japan is watching all of this with great interest. They're in the opposite position, trying to normalise policy after decades of ultra-accommodation. And they're facing their own version of the inaction problem. Governor Ueda has been talking about the pros and cons of raising rates at their December meeting, stressing that conditions are forming for a potential hike, but also emphasising the need to assess wage data and monitor global developments. In other words, maybe we'll hike, maybe we won't, we're watching, we're thinking, we're considering it. And Japanese bond markets are doing backflips. 10-year JGB yields have surged to levels not seen since 2007. Not because the BOJ actually raised rates, they've been stuck at 0.5% since January, but because markets are pricing in the possibility, the uncertainty, the risk that normalization might actually happen. The yen is behaving accordingly, weakening despite interest rate differentials that mainstream theory says should strengthen it. Because differential-based models assume central banks follow predictable reaction functions, they assume policy is mechanical, data goes in and rate decisions come out. But when central banks deliberately obscure their reaction functions, when they refuse to commit to specific responses to specific data, those models break down. Markets can't arbitrage what they can't predict. And if you can't arbitrage interest rate differentials, then those differentials stop mattering for exchange rates. The yen falls not because Japanese rates are low, but because nobody knows if Japanese rates will stay low. The dollar strengthens not because Fed rates are high, but because Powell won't tell you if they're going higher or lower. This is where we are in December 2025. A world where central bank inaction has become action, where strategic ambiguity is the strategy. Where the most powerful monetary policy tool isn't the policy rate, the balance sheet, or forward guidance. It's the deliberate withholding of forward guidance, the cultivation of uncertainty, the refusal to commit. And it's working, at least for now. Look at what's happened since the Fed's decision. Markets initially rallied. The Dow gained nearly 500 points, but that rally wasn't pricing in easier financial conditions. It was pricing in relief. Relief that the Fed hadn't gone more hawkish. Relief that they hadn't explicitly ruled out future cuts. Relief that the door remained open even if nobody knew what lay beyond it. But as the days pass, as markets digest the implications, financial conditions are tightening. Not dramatically, not crisis level, but unmistakably, Treasury yields are holding elevated. Corporate spreads are widening modestly. The dollar remains strong against most major currencies, and all of this is happening with the Fed sitting perfectly still, waiting, watching, evaluating. The genius of this approach is that it's self-adjusting. If markets tighten too much, if financial conditions become genuinely restrictive, the Fed can always step in with dovish signals. A speech from Powell emphasizing flexibility. A leak to the Wall Street Journal about concerns over market function. Suddenly, expectations shift, conditions ease, crisis averted. Without ever changing policy, and if markets get too loose, if risk appetite surges and financial conditions ease despite the Fed's pause, they can tighten expectations without tightening policy. A hawkish speech from a regional Fed president. Anonymous sources are suggesting the committee is concerned about inflation. Markets recalibrate. Conditions tighten. Problem solved. It's a monetary policy by expectation management, and it only works when central banks refuse to commit to specific paths, when they preserve maximum flexibility, when they keep markets guessing. The question is whether this can last, whether markets will eventually demand more certainty, whether the lack of clear guidance will eventually undermine confidence rather than maintain it. Because there's a thin line between strategic ambiguity and loss of credibility, between preserving flexibility and appearing lost, between data dependence and data paralysis. We saw hints of this in the Fed's December meeting. 3 dissenting votes, the most since the pandemic. 2 members want to hold rates steady, 1 wants a bigger cut. And Powell acknowledged differing views within the committee. This isn't confidence. This is a genuine disagreement about where the economy is headed and what policy should do about it. When central banks disagree with themselves, when internal divisions become public, the strategic ambiguity starts looking less strategic and more genuinely uncertain. Markets can sense the difference. They can smell when a central bank is deliberately cultivating uncertainty versus when it's simply lost in the data. And that difference matters enormously for how markets react. For now, markets are playing along, accepting the new normal of perpetual uncertainty, pricing in scenarios, hedging outcomes, building in risk premiums, all of which serves the central bank's purposes. But if economic conditions deteriorate, if unemployment rises or inflation surges, or financial stability comes under threat, will markets still trust central banks that refuse to commit? That preserve flexibility above all else? The European situation offers a cautionary tale. The ECB has been pausing since September, holding at 2% while emphasising data dependence and meeting-by-meeting decisions. And European markets have mostly accepted it. Growth projections are modest but positive. Inflation forecasts show convergence toward the target. Labour markets remain resilient, if not robust. But underneath the surface, there's fragmentation. German industrial output is stagnant. French fiscal policy is in crisis. Trade tensions with the United States are simmering. And the ECB's refusal to commit to any particular policy path means national governments can't coordinate fiscal policy with monetary expectations. They're flying blind, hoping that whatever the ECB does or doesn't do, it won't conflict with their own stabilisation efforts. This is the hidden cost of strategic ambiguity. It works for financial markets that can adjust quickly, that can reprice risk in milliseconds, that can hedge and adjust and reposition based on every new data point and speech and press conference. But it fails the real economy. Businesses are planning investments, households making spending decisions, governments coordinating fiscal policy. They need more certainty than markets do, and they're not getting it. The Bank of Japan knows this acutely. Japanese households have been crushed by import price inflation driven partly by yen weakness, and that yen weakness is driven partly by policy uncertainty, by markets unable to confidently predict the BOJ's normalization path, by the absence of clear thresholds, targets, or frameworks for when and how much they'll tighten. And so Japanese households keep falling further behind. Real incomes are declining despite nominal wage gains. Household spending is crashing despite the BOJ's claims of pent-up demand. The disconnect between what central banks say and what households experience has never been wider, and strategic ambiguity about future policy only widens it further. Because if you're a Japanese household trying to decide whether to spend or save, you need to know if rates are going higher, if your mortgage will reprice, if your savings will finally earn a decent return. And the BOJ's response is, we're considering the pros and cons. We're monitoring developments, we'll decide meeting by meeting. That's not an answer. That's an invitation to paralysis. Same thing in the United States. Businesses trying to plan capital expenditures for 2026 need to know if borrowing costs are stable or rising or falling. And the Fed's response is, we're well positioned to wait and see. That might work for financial markets. But it doesn't work for the real economy that operates in longer time horizons than overnight repo markets. This is the fundamental tension at the heart of modern monetary policy. Central banks have optimized for market management, for keeping financial conditions stable through expectation control and strategic ambiguity. But in doing so, they've sacrificed clarity for the real economy, for businesses, households, and governments that need to plan beyond the next FOMC meeting. And we're starting to see the costs. Business investment growth is moderating despite relatively accommodative financial conditions. Household formation is slowing despite falling interest rates. Long-term planning is becoming harder even as near-term volatility is contained, because uncertainty about the path of policy creates uncertainty about everything that depends on policy. The irony is that forward guidance was supposed to solve exactly this problem. By committing to specific policy paths conditional on economic outcomes, central banks could reduce uncertainty and encourage long-term planning. But they discover that those commitments constrain their flexibility and damage their credibility when circumstances change faster than their forecasts predicted. So now we've swung to the opposite extreme. Maximum flexibility, minimum commitment. Data dependence is taken to its logical conclusion, and markets are managing it reasonably well. But the real economy, the one that exists outside trading floors and futures markets, it's struggling to adapt to a world where the only constant is uncertainty. December 2025 marks a turning point, not because of what central banks did, but because of what they didn't do. The Fed cut rates but signalled it might stop. The ECB held steady but refused to commit to continued pauses. The BOJ talked about hiking without actually hiking, and in all three cases, the inaction spoke louder than the action. Markets moved not on policy changes but on policy uncertainty, on ambiguity, on the deliberate cultivation of multiple possible futures. And for now, that's enough to keep financial conditions in the right range. Not too tight, not too loose, just uncertain enough to prevent excessive risk-taking without triggering panic. But this equilibrium is fragile. It depends on central banks maintaining credibility while refusing to commit, on markets accepting uncertainty as the new normal. The real economy continues to function despite the absence of clear policy signals. Any of those conditions could break down quickly if circumstances shift. And circumstances always shift. That's the one certainty in an uncertain world. The question for 2026 is whether central banks can maintain this delicate balance, whether they can keep markets guessing without losing their trust, whether they can preserve flexibility without appearing rudderless, whether strategic ambiguity remains strategic or just becomes ambiguity. Right now, the bet is that they can. That data-dependent, meeting-by-meeting policymaking is the best approach for a world where the economy keeps surprising us. Where inflation behaves differently than models predict, where labour markets tighten even as growth slows, where currency values decouple from interest rate differentials. But that bet assumes markets will keep playing along, keep accepting uncertainty, keep pricing in multiple scenarios without demanding resolution. And history suggests that acceptance has limits. That, eventually, markets demand clarity, demand commitment, demand a sense that central banks know where they're going, even if the path keeps changing. We're not there yet, but we're closer than we were. The 3 dissenting votes at the Fed, the public disagreements about the appropriate policy stance, the widening distribution of dots in the dot plot, these are cracks in the facade of data-dependent flexibility, signs that the internal disagreements are becoming harder to paper over with strategic ambiguity. And when those cracks widen enough, when markets start questioning whether central banks are deliberately preserving flexibility or simply lost in the data, that's when inaction stops being a policy tool and starts being a policy problem. When uncertainty goes from strategic to destabilizing. When the refusal to commit goes from confidence to confusion. The central banks of December 2025 have mastered the art of influential inaction. They've learned to move markets without moving policy, to tighten conditions without tightening rates, to preserve flexibility while maintaining credibility. It's an impressive achievement. A remarkable demonstration of how monetary policy in the modern era depends more on expectation management than on actual operations. But every policy regime eventually runs its course. Every framework eventually breaks down when circumstances shift enough. The question isn't whether this era of strategic ambiguity will end. It's when and what comes next, when markets stop accepting uncertainty as an answer and start demanding clarity as a right. For now, central banks are content to keep us guessing, to cultivate ambiguity, to let their inaction do the talking. And markets are responding exactly as hoped, pricing in risk, building in premiums, tightening conditions without explicit tightening. But underneath the surface, the contradictions are building. The real economy is struggling for clarity while financial markets thrive on uncertainty. Households are falling behind while equity markets soar. Central bankers are divided while maintaining a united front of data dependence. Something's going to give. The only question is, what breaks first? The market's acceptance of perpetual uncertainty, central banks' ability to maintain credibility without commitment, the real economy's capacity to function without policy clarity? We'll find out in 2026. And when we do, we'll look back at December 2025 as the moment when central bank inaction reached its apex, when the power of doing nothing peaked. Strategic ambiguity worked exactly as designed right up until the moment it didn't. That's the real lesson here. Not that central banks have discovered some new perpetual motion machine of monetary policy, but every tool has limits. Every strategy has expiration dates. And the most powerful tools often contain the seeds of their own obsolescence. The era of central bank inaction is working brilliantly right now. But like all brilliant strategies, it works right up until it stops. And when it stops, we'll remember December 2025 as the peak. The moment when doing nothing was everything, when silence spoke volumes, when the most influential policy moves were the ones that never happened at all.